Hi, I'm Lynda Hafner, top producing realtor at ERAQ Realty in Central Massachusetts. Today I'm continuing on with answering questions that first-time home buyers have. And one of the popular ones that I often get is they ask me what MI or PMI is. What does it stand for? What is it and why do I have to pay it? So let's talk about that. Obviously, I'm not a lender, I'm not in the banking profession, I'm a realtor, but I like to help my clients as much as I possibly can and share whatever information that I can. For more detailed info, I always recommend talking directly with the lender, but for today, I'm just gonna give you a little bit of a brief overview. So there's this thing called, and I have talked about it in some of my other videos, of MI or PMI, and that basically is short for mortgage insurance, and PMI is private mortgage insurance. They used to call it PMI, now they seem like they just call it MI. So what is it? Usually it affects first-time home buyers the most because they don't have equity from a previous home that they sold to put down a significant amount of money on a home. They're looking at like less than 20% down payment, and that's where you get stuck with mortgage insurance. If you are one of the very few rare people that actually has 20% down to put down on your first home, then congratulations, you can skip this video. You don't need to know about MI. But most of the clients that I work with don't have that amount of money when they are buying their first home. So they are indeed in need of MI, and they often don't understand the terminology. So let's go over what it is and what the terms are and just go into a little detail. Why do first-time home buyers need mortgage insurance? Well, you don't need the mortgage insurance. The bank needs the mortgage insurance in order to give you the loan. Basically, it's that if you only have 5% down payment, okay, they're giving you 95% of that home's value, and they require you to pay mortgage insurance is basically a safety net for them. In other words, if you suddenly lose your job and you're in default and unable to pay your mortgage, and they have to repossess that home, and then what if the market has changed since you bought it and it's gone down and they can't get, the whole 100%, the gap between what you put down and what you have invested in that home and what the value is, that mortgage insurance covers that gap so that they are not losing money. So it's really just a protection for the bank. It would be great if the banks didn't force you to get it, but they do. You can't purchase a house if you have less than 20% down without the mortgage insurance. So I would love to just be able to give you this number and say, okay, this is how much you're going to pay in mortgage insurance, but it doesn't work that way. Basically, how they calculate mortgage insurance is based on the risk factors that they view you having. In other words, the higher the credit score that you have, the less mortgage insurance you'll pay, and it moves incrementally down. So the lower your credit score, the more you'll probably end up paying in mortgage insurance. These are all numbers that I don't know. They vary per lender, per loan, per circumstance. So I can't go into any of that detail. That is between you and whatever lender you choose. I would definitely make sure that you know what that number is, though. It is important because that's going to affect what you can and can't afford for a purchase price. So these are all things to consider. How much you pay in mortgage insurance also is going to be based on how much you put down. So the less you put down, say you only put 3% down, you're going to end up having a higher mortgage insurance payment than if you put down 10 or 15%. It's all going to be rated based on a couple of different factors. And again, just make sure you know what those are. I think most of my clients end up paying in the range of somewhere, I would say like a little over 100, maybe 130, up to two, in that price range, 225 maybe. Again, this is something that you need to figure out with your lender. But another important distinction that I want to make with you is the difference between when having mortgage insurance with a FHA loan and a conventional loan. With a conventional loan, you only pay the mortgage insurance up until you have 20% equity. And at that point, you're able to not have the mortgage insurance, and it happens automatically, and you don't have to refinance in order for that to happen. With an FHA loan, it doesn't work that way. You actually would have to refinance your home in order to remove the mortgage insurance. So this is, again, something else you want to take into consideration. Because if you have an FHA loan, that means you have a little bit of a lower credit score and you're a little bit more of a higher risk, and that's why they don't take that away. I don't actually know, it's a government program, but that's just the way the system works. So be aware so you can make these decisions in advance before you are already in the process. So that's it for today. I hope you learned something from this video, quick and easy today. Next time, we're gonna talk about how to get started in the process of buying your first home. That'll be the 13th question of all the most popular questions that I get from first-time home buyers. So I hope you will tune in and catch that in a couple weeks. Have a great day.